We're going to take a look and see how investors buy securities. Here it is, a stockbroker. A stockbroker will be happy to sell you stock, they'll be happy to sell you bonds. There's a lot of different ways of doing it. You can actually have a person, an actual, honest to goodness human being, you can talk to about buying stocks and bonds. They have to be registered. There's all kinds of different licensing requirements they have to have, but they also get some money. You have to pay them somehow. Some brokers charge zero trading fees, but there's an expectation as to how they receive the money. Robo advisors, they're automated a lot of times, are tools that use different algorithms and give you investment suggestions. And by the way, I want you to pay attention to that market. Artificial intelligence is totally changing the markets. And I'm going to give you some cautions about the markets because a lot of times, from my perspective, stock is not a smart investment. There's all kinds of problems with it. But that being said, you're competing against big people, the big players, the investment banks. You're competing against these retirement funds, insurance funds as well. But also now in artificial intelligence, that little critter at the bottom says robo advisors. It just depends on the level they have. Some AIs are brilliant and there's some good investments, but you have to be careful because this is all a gamble. When you buy securities, you actually buy them as part of your investment portfolio. And you may have a whole series of things. Probably one of the most, if you're interested in this area, I recommend you take the class called Digital Investments, which I also teach. There, I'm using pretty much as a quasi textbook, The Intelligent Investor, which is an old book. It's a 1949 book recommended by Warren Buffett, who's probably one of the smartest investment people out there. The original printing was that they revised it, but really what the formulaic aspect of that book really is a good job in the aspect of explaining things. The recommendation is only spend 10% of your total portfolio for your wild money. Wild money are things like cryptocurrency. I teach crypto and I have my own crypto account, but I have to tell you, it is a giant roller coaster because it's crazy. That's a whole nother class if you're interested in it. For stock, though, figure out how you're going to invest. Do not go into this, do not take this class and think you're going to roll out and become a champion investor because you're not. You have to spend time analyzing it. This is an overview class. It is not specificity for different types of investments. Even the cryptocurrency class is not that, or digital investments is not that. You need to sit down and focus in onto the securities you want to study. And my recommendation to always have some type of advice that you're following. If you're going to go out on your own, you can make money, but you can also lose money really quickly. But a stockbroker will provide that aspect for you. Sometimes you get an advisor, an advisory firm. They can talk to you about your entire portfolio. Sit down with your expectation, what you have. But no matter what happens, you have a right to know exactly what they're charging and how you're going to pay them, because of the fact that they're not doing it because they like you. I'm sorry, they're doing it because they get a fee out of it. Know how they get their fee. Sometimes you buy something and sometimes it's front loaded. So you buy something over here, you pay a fee up front. Sometimes it's back loaded. So you pay a fee when you sell it. It just depends how it's set up. And sometimes, if like a mutual fund, you're going to pay an investment manager a fee on a monthly basis in the process as well. So no matter what happens, somebody is making money in the process. Know how they're making money, and that'll help you make your decision if you want to buy into it. But also, if you buy into it, as to how they're making money and how good they are in the process. So pay attention to your investment advisor. We call them an RIA. Okay, they're going to give fiduciary advice about your different aspects. Choose the right investment strategy. Here's 5 criteria that are normally used out there. This is actually in the textbook, but it's also in the intelligent investment. The investment risk, the yield you're going to get, how long, how liquid it is. In other words, if something happened, can they sell it all within a year? And the tax consequences, all those play a role. Do more than take this class. Take an investment class, talk to experts. Go to a conference on this. There's a lot of them out there. They're going to charge a fee and they'll give you a sales pitch to buy their services. And sometimes it's good, but make certain you don't have your head in the clouds. You're going to get rich overnight. It doesn't work that way. It only works that way in Hollywood. And it's always cute there because they always have problems by the time they're all done with the money. Head to the library, pick up investing books, have a diversification plan. A diversification plan means don't put all your money into one basket. Don't buy all stock. You want to diversify and have stocks, bonds, mutual funds, ETFs. There's a whole series of things. I'll touch a few of them, but you want to have different types of things with different focuses. And mutual funds, I prefer to sit down and have some mutual funds based in the United States. I have one actually based in South America, one based on Asian economies, one on real estate, one on different commodities. So it depends what you're looking at. You want to have diversity sometimes in the type of funds, sometimes in the actual geographic, but also spread out your risk. So in case something, if you put it all in technology funds and technology funds all crash dive, you don't lose all your money. Have different types of funds. We call that diversification. Small company stocks overall, surprisingly, that over the counter stuff we talked about early on, it pays better than large company stocks. But you might have to buy a lot of them because a lot of them, they go belly up or never move at all. But every once in a while, you get one monster that comes out there and you bought it for 49 cents a share, and all of a sudden it's selling for $5 a share. Whoa, that's 100. That's a lot of money. Okay, but it's all about scope and scale. Corporate bonds, the end return is 6.3. It's a lot safer to get a corporate bond than a company stock. But that said, you'll see over here, long-term government bonds is almost as safe, but it is totally safe in the process. And look at treasury bills. So it depends what you're out there investing for. You'll see different aspects of it. Diversification, diversify your strategy by allocating different things. If you have a good diverse portfolio, you're going to have a better chance on losing everything when you sit down, because one part of your portfolio crash, usually a lot of times the other part didn't. You'll see if you pay attention to the stock market, you almost have this thing, a teeter-totter effect. Historically, stocks and bonds do not rise at the same time. Usually the stocks are going up. Over here, you got your bonds going down. When bonds go up, stocks tend to go down. You'll see that aspect of it. So it depends what you're doing in the process. So look at different aspects as to how that's happening. And you want to sit down and pay attention to the diversifications out there. We had problems now recently where they both rose, and the stocks and bonds, and they both sank in the process as well. So you see different parts of that. So investment, saving, get some savings investment advice, help with the 401k, retirement planning, tax planning, estate planning, educational expense planning, have it out there. A lot of times the terminology that we use, there are bulls out there. And by bulls, you're talking about when you have a 20% gain in the market in a short period of time. We don't define what that means, but it's a 20% gain. That's a bull market. Or the bears, if the market's crashing for a period of time by 20% or more, we call that a bear market. So bull market, buy, buy, buy. Bear market, run, run, run as fast as you can. Capital gains is the positive difference between the purchase price of a stock and its sales price. So it depends where you're at with that as well. Selecting stocks, there's different kinds of stocks to choose from. Blue chip stocks are your best type of stocks you can have. Your growth stocks are those that are continually growing in value over time. Income stocks are really the aspect of you're getting money on a regular basis by getting a dividend. Penny stocks are literally that, stocks that are worth less than $1. Pretty much account $2 too as well in the process, but they're low value stocks. And you can actually get an awful lot of money if you know what to buy and you buy at the right time. So when you buy and sell a stock, you normally have a market order, we call it. It tells the broker to buy or sell a stock at the best price, or a limit order, depends what it is, if that price becomes available. So different terminology that we have. Bear markets, they happen. Here's some time periods you can see of different aspects that happen here. What the most recent one we had, a serious bear market, was 207 to 209. We had something of a bear market really in 2021, but then it kind of came back, so it didn't really count. It wasn't long enough for whatever the analyst came up, but it's really kind of a scary thing. There's something out there also called stock splits. Stock splits don't do anything of value. All they do is they split. The shares are paid for $100 a piece, and you have a stock split, a 2-to-1 stock split. So all of a sudden now, for every person that owns one share of stock, now they own two. And let's do the math. Let's see, $100, it got split in two, so each share is worth $50. Duh, this is not rocket science, except for the fact that people surge and they get excited about stock splits. Oh, wow, they got a stock split coming. So everybody anticipates a stock split happening, and everybody rushes to buy it. And I've only one time I saw a stock split happen where the stocks pretty much stayed exactly the same value. But one time I saw a 50-to-1 stock split and everybody went nuts because the stock was selling for over $2,000. 50-to-1. Oh, everybody got all excited about the process. And so all of a sudden they got excited and the stock did indeed split, but the value of the stock was greater than what it should have been from a technical thing. Stock splits do not provide technically any value, but people get excited about them. Buying stock on margin. This is what caused the Great Depression. People were buying stock on margin. There's a lot tighter laws on buying on margin, but back in the Depression eras, there weren't, and people were buying stock. They would sit down and only have 1 or 2% of the money, and they're buying stock, and literally all of a sudden somebody would call it in, and they had to come up with the other 98%. That caused the depression. You'll see different levels over here. A lot of times a broker is going to be cautious about what they're loaning you in the process as well, because that's exactly what it is. On your stock quotations, you're going to have if you go into the Wall Street Journal, which is the one I recommend the most when it comes to buying stocks, there's multiple other ones out there. Okay, there's the highest and lowest price for that day. Okay, high and low over the last year, paid dividend, how much it was, the yield overall, and have ratios. Usually your PE ratio, price earnings ratio, is the one that they put out there the most, and then EPS, earnings per share, and the number of shares traded. Here's an example of a stock quotation. You can see all those things over here, how much it opened, and you'll see the aspect of the bid, you'll see the asking price, the range. It ranged from $71.56 to $72.19. It closed, and you see at the very top there, 71.74. So you see all those different aspects out there. So pay attention to what it is, because if this is yours, you'll be watching this on a regular basis. Under strategies, have an investment strategy, which you plan on doing. Have a good portfolio with diversification to it. Buy on margin. That's about having your broker being able to sit down and extend credit for you. And they might call that margin in depending upon what it's like. So it depends on the conditions of your broker. And what a capital gains is, that's the profit when you sell stock, and then also what a stock split. How investors buy securities. Make up your own formula and your own methodology of doing that, and you too become wealthy. And make sure you put 10% into the Irvine Valley College Foundation. So that being said, there's a lot of different ways of buying securities. Make sure you find a strategy that you're comfortable with, but only do it after sometimes educating yourself very thoroughly, because all stocks and bonds, this whole area of securities, is risky. So go into it with your eyes open and with some intelligence supporting what's behind those brilliant eyes. Take care.